Hello and welcome to our Diwali special show here on Business Today. I'm Abha Bakaya. With me, our managing editor, Siddharth Zarabi. This indeed is a Diwali to remember because of absolutely rocking returns and the amount of wealth creation we've seen in the past 1 year. The Nifty has outperformed the world with over 40% returns since last Diwali. World markets have created $60 trillion of wealth from their March lows. And as we get into the new Samvat, let's discuss what the trends are going to be like going forward. Which themes and sectors will do well? Our three special guests on the show, Atul Suri, CEO of Marathon Trends, Devina Mehra, founder and chairperson, First Global, Nilesh Shah, MD and CEO, Envision Capital.
Wonderful to have you on the show, everyone, and wishing you a very, very happy Diwali and a Samvat 2078. I'm going to start with you, Nilesh. 2077 Samvat, the past year, has been a wonderful year. We have seen unprecedented amounts of wealth being created in the markets, and more importantly, a new sort of retail revolution, fresh entrance into the markets. Given all of that, what's the outlook for the next Samvat? Will it continue to see the kind of good times that we saw this year?
Well, happy Diwali and a happy new Samvat to you, the entire team, and all the viewers. Yes, absolutely. It's been a stunning Samvat so far. One of the best in my own careers, and honestly, it's been fantastic. It's been gratifying. What it looks like, of course, is that we've run some really good course, but I still expect that even the forthcoming Samvat will continue to be a good one. May not be as good as what we have seen in terms of, say, the returns or the upside that we've seen and witnessed so far, but I still believe that it is going to be a great year ahead. Still expect the economy to kind of grow in high single digits, still expect interest rates to remain low, and still expect liquidity to be benign. So these are this is a great combination to have for the bull market to kind of, in a way, keep marching ahead. What could, of course, change is basically it could just be a very different set of sectors which could end up being outperformers. It's not necessarily that what has worked in the last 1 year will continue to work in the coming year as well. So it's quite possible that we will see a different set of sectors and a new kind of leaders emerge over the next year or so. But on the whole, still expect great times ahead.
Devina, how closely have you been monitoring the kind of emergence we've seen when it comes to some of the new age tech companies, the disruptive players as they are called? And yes, some of them are very different to others. There's been a far better response to something like a Nykaa than there was, for instance, with a Zomato, which led to a lot of debate. What are you making of some of these emerging trends?
As I have said in the past also, all these companies listing here is a good thing for the markets, it's a good thing for the companies, it's a good thing for the investors who had invested in them along their journey as a private company. And it is good that this market has not got exported to the Nasdaq or Singapore or something like that. Having said that, from the investors' point of view, I would still advise caution because a lot of people are investing not having studied the companies or anything like that. I mean, they are really investing in the IPO process that there will be someone willing to pay a higher price. And both in India, if you remember, I think sometimes it's negative to have too long a memory. If you remember the previous IPO frenzies, it's not as if that all the coveted IPOs which were so heavily oversubscribed actually did well in the aftermarket. And even internationally, if you look at Uber or Lyft or DoorDash, the aftermarkets have not been that great. So and here, like, the valuation can be any number you pick out of the sky. So it is not price to earnings anymore. I mean, I was comparing, for instance, Nykaa to Ulta, which is a comparable company, and even on price to sales, you are way off. So it's a great business built. I mean, all compliments to Falguni, who was a year my senior at IIM. So, but what is the number you want to pay for it is a different matter. And also, there's also a question that whether it's better to have earnings or not have earnings, because when you have a E, you have a PE. So there is a benchmarking involved. So those are the questions. So I would advise caution as far as the new age tech companies are so-called, I mean, there's not really tech, this is like consumer internet, half of them, or consumer D2C delivery of some sort. Be cautious. I mean, who's to say, of course, where the valuations will end up if you look at any of these companies. If you look at DMart also, the valuations went far higher than what sitting there at the IPO stage one would have thought possible. So that's another matter. But at least it should not be an outsized part of your portfolio or your mind share. That's the caution.
Right, Devina, that's an important bit of advice. And Atul, I want to come to you on that, especially a question about how you see India being placed as far as valuation and earnings are concerned. And while you answer that, a quick comment also on Devina's sort of note of caution on IPOs. What's your outlook on that as well?
So just to put in perspective, this last Samvat has been nothing but an extension of what has been happening from COVID bottoms. You know, the index has moved up 150%, I think, from where we were 7,500, and today we are at 18,600 or so as a high. So it's been an extension of that. We have been a spectacular market in the global context also. We have probably been among the best performing, if not the best performing market over this time phase. But what I really think is that it is, most people get surprised and shocked. There's like total awe as to what's happening. But the thing is that whenever we have studied that in the past, markets have crashed, like let's take 2000, we had an IT crash. Post that, markets always have this spring action, where markets get oversold on the way down. And post that, you have a spectacular vertical move. So 2000, the market fell 40%. That is the IT bubble when it burst. And in 2003 to 2004, the market went up 120% in 9 months. Right? Similarly, in 2008, we had a market that fell 60%. That's the financial market crisis. And from 2008 bottom to 2009, we were up 180%. So markets tend to, after crashes, have this kind of spring action. So what we are seeing is not something that's totally out of the box. But what we notice is that post these pullbacks or sharp pull-ups, or what I call a compressed spring action, markets need to consolidate. And I feel that going ahead, the action is not going to be so much in the index. Markets need to, when you run very fast, you need to catch your breath. If you don't catch your breath, you're sooner or later going to collapse. So I feel that the markets will sort of consolidate. They will need some time. You will have to have some time-wise correction. And I think this is also the time when you could see sector rotation, because sectors that have been in the fancy for the last few years have essentially been a very risk-off kind of play, have been very defensive in nature. But two things that have been happening. One is the way commodity prices have been going up. And second is also the expectation that India would see an economic revival. I find that there will be a churn that will happen in this phase of consolidation. So I think it's a very exciting time. Yes, your whole digital play is another exciting area. And every bull market throws up a new sector, new leadership. 2000, we had all these internet companies, and we had this whole hogwash of eyeballs. And companies were valued based on how many people went to your website. Of course, it ended badly. In 2008, we had this land bank thing, with real estate companies, and we know that even today, most of them got wiped out. And I guess with this new thing, just to extend from where Devina is, we'll come up with a new term, new thing, new valuation parameters. And one will have to be cautious, because there's no running away from earnings, which is the central theme. And one wonders how many of them will really go out and deliver the promises that they are on. So broadly, I think that we would head into a consolidation phase. We would see sectorial change, but this whole digital play will throw up some amazing leadership, but not everything is going to be a sweet spot. So one will have to be very, very careful of what we invest in.
Okay. Well, talking about earnings and valuations, Nilesh, given the way everything has been moving, we've seen a fair amount of rotation. We've also started to see broader participation. What really stands out now going forward? Where do you feel we'll continue to see a sustained trend and constant performance?
Well, I still expect most of the businesses to continue to kind of grow and do well. It's a different thing that maybe the current prices for several of these sectors, in a way, factors in their near-term growth prospects. But a few sectors which I think could potentially be outliers over maybe the next year or beyond. First, I clearly believe is that the real estate sector is in for better times. They've gone through the J curve, they've gone through all the tough times. A regulator came in, a lot of cleanup has happened, the weaker players have kind of fallen by the wayside, and we see some very handful of capital efficient players out there who have always believed in delivery and who have always believed in delivering a superior product to their customers. So clearly believe that real estate is probably in that same kind of a cusp of a similar kind of an uptrend. We saw this when markets rebounded sharply from the lows of 2008 to the highs of 2010. After that, essentially, is when property prices started to go up. I'm not quite sure by to what extent property prices will go up, but demand is back, and clearly that's great news for some of these real estate developers. So I clearly believe that's one sector which probably looks good. The second spot which could essentially be a opportunity is essentially this whole PSU banking space. We don't yet own any PSU bank, but we're getting increasingly constructive on that. I mean, just before I stepped into this show, I saw Bank of India announce numbers, and they show basically a 2x growth in their profits for the quarter, which means that they now have a lot less provisioning to do. A lot of the pre-provisioning operating profits are flowing into the bottom line, and all of this essentially means elevated levels of ROE. And when you have higher ROE, that leads to better valuation. So I think we're at a stage in the market where we need to look not just for a much higher level of earnings growth, but where there's a potential for re-rating. I think that's basically the big opportunity. And I clearly believe that real estate as a pack and some of these state-owned banks is where there could essentially be both a superior earnings growth as well as a scope for re-rating. In addition to that, I also believe that this whole broadcasting space and the entire media space, again, could do very well over the next couple of years. Keep in mind that the economy is on a rebound. A lot of conventional sectors, be it automobiles, homes, education, are all going to start advertising in a big way. And that's good news for some of these broadcasters. In addition to that, the next couple of years is election times, which means you're going to see increased spending. So these are the three pockets which I believe have not run up quite significantly, and there could be even better days ahead for some of these sectors.
Good points there, Nilesh, and especially the broadcasting and media space. We've seen tough times in the past few years, so I'm really hoping that you are bang on spot on that. Devina, I want to take that theme forward. 4 broad points that Nilesh highlighted: the real estate theme, state-owned banks, broadcasting, and overall, the political economy factor. How do you read the political economy, and also add any sectoral perspective that you might have at this stage?
Okay, let me first give you my market perspective because I haven't really spoken about that yet. And so first of all, yes, there has been this huge run-up which we spoke about at the beginning, that it's been a very good Samvat. But if you look at it historically, there was room to make this big move. If you look at each decade's returns, if you look at from the beginning of the Sensex from 1980 onwards, the first decade we compounded 21%, then 14%, then 17%, and 2010 to 2020 you were only at 8.5% or so. So that is why if you see going back from 2020 for 5 years, most equity mutual funds did not even meet savings bank returns. For 10 years, they did not beat fixed deposit returns. So that's where you were. So that is why even after this run-up, if you look at on a 12-year basis, you compounded only 10.5%. So you're still not come back to the trend line, let alone be way above trend line. So that is the source of comfort, if you can so say. So that is why if there is a correction which we are, or sideways movement, it is probably not cause for alarm. And this might also test out all the new investors that you spoke about in the beginning, that they had come in. And so this is like they saw only one side of the market. So this is a testing time maybe for them if the market corrects for a while. But otherwise, as I said, the risks don't appear very high simply on that the returns are not way above trend. And normally big crashes or big bear markets come when the markets are way above trend. That is one part of it. Of course, last year, I mean, we follow a very diversified strategies, for starters, and that has given us not just a very substantial alpha, but also very, very good risk-adjusted returns. So, so risk is one part which every investor should always be cognizant of, that what is the system you are following to manage your risk. And in terms of sector themes, some sector themes which we have liked for a while still continue. IT services, for instance, which we identified about, more or less the time we started our PMS a year and a half ago. So at that time, the FMCGs were the flavor of the month, and I said that FMCGs, yes, they have good cash flows, good all of that, but IT services also have great cash flows, good margins, predictable returns, and they are a dollar hedge. And in very uncertain COVID times, that was one business where the demand was relatively more certain. So they have done very well. That theme still continues. I think IT and other tech still remains our number one bet sector-wise, even though, I mean, when I say number one, it still doesn't mean that we have 25% of the fund in that. So that's not what I mean. Selectively, chemicals still continue, cement and metals, but of course, with some caution that you have to watch out. I mean, metals have been huge winners for us, but we have trimmed somewhat. In terms of what is changing, in my view, from what has been my view earlier is financials. I am always extremely cautious on leverage plays, and particularly banks and lenders, because it's been proved right. I mean, 2020, I think Nifty Bank was the only sectoral index that was actually down for the year, and this year also the Nifty Bank has underperformed the NSE 500, etc., all the indices. But now that might change. I mean, I'm not saying that's going to be the best performing sector, but I think there are somewhat better times ahead for that sector. And also, as rates creep up, typically for lenders, that's a good thing, because your assets get repriced faster than the liabilities. So some amount of cleanup has happened. So that is like not contrarian from the market point of view, but contrarian from my usual point of view. That's different sector from what I have liked in the past, but you have to be flexible. That's the whole thing. You can't be married to a philosophy, which is why, you can't say that you'll always buy only great companies with great cash flows, which is why we got the metal cycle very well from almost a year ago. And that made us a lot of money. So in the market, the key is to be flexible, which is why we have the hare as our mascot, that you run fast, but you can change direction. And you want to emulate the hare in that it has 360-degree vision. So that's what you want to do. You want to be alert and alive to the changes, because last year and a half, things have changed very fast at various times. So
absolutely.
So be diversified, be cognizant of risks, but I don't think there are like a major crash ahead.
Okay. Welcome back. You're with our Diwali special here on Business Today. While we are still on a high this Diwali, have to ask you levels, have to ask you, targets or anticipated levels. Can one even predict this market the way it's going? Who would like to take that first? Nilesh?
No, absolutely. I mean, levels is actually the most dangerous thing. I don't think we should get. I probably believe that over the next year or so, I mean, for the new Samvat, I don't think the levels are going to be something which one should look for. And it's quite possible that this may not essentially be in a way where everything just goes up. So to that extent, I believe that investors, I think for the coming year, should be a lot more bottom-up focused than what they have been over the last 18 months. Over the last 18 months, a broad-based approach has worked. Maybe over the next 12 months, it's going to be very, very sector-specific, stock-specific.
Have you taken a look at Bitcoin? Is that completely off the list? Is that something that's at least, sparked any curiosity?
Yeah, I mean, absolutely. I mean, I know that initially we all write off Bitcoins, but the more you listen to it, I do feel that it's something you can't ignore. because it's no longer a very small market, it's a very large market. And, the size itself lends it a lot of importance. The number of people who are following it. So I, for one, definitely think that, I'm looking at Bitcoins and I do invest in Bitcoins. And it's interesting because for someone like me who looks at charts, etc., Bitcoin is something that doesn't have fundamentals.
Exactly.
Right? It's a pure demand-supply game.
Yeah.
So for me, that really works perfect, and it's up my alley in that sense of the term. So I really enjoy Bitcoin, and I do some work in it. I know that most people, especially in India, are in a denial mode, but with a small allocation, for me, it's a great educational thing. It's being on the ball, really, because you don't know if it ever becomes a reality of what people view it to be. I think it would be nice if I am on the ball rather than be late on it. So I do invest or play Bitcoins, if you like to say, more out of my personal growth, to be aware of it, because there's so much happening. I mean, it's like a different world out there. It just blows your mind. It just blows your mind. So I think it's extremely fascinating. So I do Bitcoins, I do Ethereum. I just limit myself to 3 of them actually.
Okay.
So that's something. As I said, it's not about an allocation. It's nothing substantial, but it's a small allocation, but more out of being on the ball and not realizing after some time that you missed one of the biggest mega trends of our life, which already, if you see the price point of view, I mean, we talk of equities, etc., the biggest returns in the last, few years has been cryptocurrencies.
Yeah.
So that's a disclaimer. That's the reality. And as far as index levels go, as I said, I personally think that we could be consolidated. We could have a largest range, maybe 16.5 on the downside, maybe towards 19 on the upside. This is about 15%. And I think that it will be interesting. There will be sector rotations. The moment you get all bullish on some sector, you'll realize that something else will move. It will not be like what it is last year. Markets have been one way up. They hardly have corrections. Everyone's had, especially the retail investors we spoke about, have not seen a correction.
Yeah.
When it doesn't happen, we will see corrections. People will get tested. It will be a tougher year. And that's, I think, what pans out. And that's what history has shown us. That's what my study of all previous crashes and post that movements have shown me.
All right. Thank you all so much for joining us. It's been such a wonderful conversation and getting a perspective from all of you, getting a lot of good advice from all of you, and also a clear indication of really what the trends are going to be.
And what not to do, Abha, and what not to do. So if you've been, do play this on repeat, because some of the best experts in the market have told you what not to do. And that's what is really the name of the game at this stage.
Absolutely. And Nilesh, I hope your smile is as big the next time that we speak as well. Thank you.
Yeah, absolutely.
Thank you, Devina. Thank you, Atul.
Thank you.
Thank you.
Thank you. And happy Diwali to everybody.
Happy Diwali to everyone.
Happy Diwali.
Bye.